First, I want to say thank you to the organizers and the sponsors for having me here today. I'm super grateful to meet all the Ruby community here in Sofia. Second, I want to acknowledge that it's a beautiful day. We have a beautiful lunch. It's probably nap time, but I'm just going to try to make it worth, right? I have been just drinking decaf for the last 10 years because of my blood pressure. And just today, I have 2 regular black coffee. So I'm so pumped that I will just go and notice on a rave in Ibiza right now. I will try to make this, that is a kind of dense talk, as entertaining as possible. And so third, I just want to introduce, and then I apologize because probably the size of the of the font is not the best for the people, especially in the back. But I want to get a feeling of the audience. How many people here has worked before in the banking industry? Okay, 2, 3 people, 4, 5. Okay, okay. Usually most of the developers that come in contact with some kind of banking is usually through 2 main experiences. Mostly their own online banking they use every day for their own accounts. And then second, processing credit cards. My talk is kind of different. We don't do credit cards. We just do account-to-account payments. So it's a different beast. And I have to acknowledge that in advance just for nobody just to get confused. So usually when we start just learning about databases, one of the key concepts is just the concept of a transaction, right? And invariably, every single time that someone is explaining transactions, they usually do like an example like this. Like you basically want to get 100 euros from one account to another account, and we are so fucking afraid of just shitting the transportation of money that we can't envision a moment where the state of the database become inconsistent. So it is like the canonical example of how you actually wrap everything in a transaction. If something happens with the second account, the first account is not debited. If the first account is debited correctly, the second one is credited accordingly. And that is in most cases what the people just think about when they hear about transfers, right? The problem is that this is not, well, it's just not real in 99.99% of the cases. What is more accurate is this kind of shitty, messy thing of what a bank looks like from the inside. Lot of different stakeholders, each one of them with their own priorities, each one of them with their own roadmap, each one of them with different abilities, skills, capabilities, authority, and the technical side of the bank is just mostly an enabler. The guys that usually run the thing are those people here. Compliance. They actually say what goes and what doesn't. And then there is like a big mess of different departments and different sections that have very complex relationships, but on top of that, there are just actually even verticals, like retail banking, or investment banking, or corporate banking, that each one of them have different priorities too, and different ways to treat their customers. So what banking really is, I just came up with this definition. It's not like an official one, but I think it reflects the big problem with banks. Is that first is a transnational distributed ecosystem. That means that even the same bank can have different branches, different countries, different jurisdictions, different laws, and the ability to issue accounts in each one of them. Then it is very heterogeneous group of players. You have big banks, small banks, we have pension funds, investment funds. All of them are just part of the banking system. They just play very different roles. They have, as we have seen before, complex internal structures. Again, different stakeholders want different things. And that is something that gets realized in different ways on how the bank treats their customers. It is one of the most heavily regulated industries, probably only second to healthcare and probably the armamentistic complex and nothing else. Like we have regulations for everything. And they have strict reliability constraints and zero tolerance for downtime. So the last thing one wants to see when they are just accessing the online banking is an HTTP 500. You don't see that in banks. It's not common. They are completely afraid of portraying and kind of an appearance of fragility and not reliability. So maybe because of that transaction, that definition was probably not clear at all. I'm asking you just to take a small journey with me about what it takes to actually conduct just one transfer, one bank transfer. And the first step that I have called step 0 happens even before we do the bank transfer. It happens when we are starting to talk with the customer. Like it may be like an insurance company, logistics company, whatever is the customer. Before we even sign a contract with them, we have to do what is called a KYB, like know your business. This is a process that is similar to another one that is called KYC. That is know your customer. Those of you that have opened like an account with Revolut, N26, any of those, you basically have to go through a process where they ask you to take a picture of yourself or just say something to the camera. Our process is much more complex because we are just onboarding not people, but companies. So we really do like a thorough, very detailed process of knowing how they work. And though this process involves all kind of things like, you know, who are your customers, who are your suppliers, how is the money flowing from your company in and out? Are you actually just providing a service with crypto assets? Do you provide loan services? Like all kind of questions, customers, ultimate beneficial owners that actually is the people that profit if the company have any kind of profits at the end of the quarter. The significant control means that, you know, there can be some people that have more than 10% of the company, and therefore they have actually a vote in the board, and they can decide which way a company should go. We have to know all of those details, and even just ask them, like, you know, how are you going to use our services? So we can determine what a normal situation is and when it's actually not normal. So before even we just sign the contract with the people that we are just going to be working with, we have to go through all this process. And usually, just this process just takes a few weeks, a few months, depending on how complex is the company. If it is like an international company, it will just take easily 3 months, because we have to actually collect information about all the people that is connected with the company in any way. So that is a long process, and that happens even before we are starting to do the transfer. So what happens after that? Well, let's imagine that we have like basically a customers, and that could be like again like an insurance company. And our customer is the insurance company, and they have their own customers. They are just the people that are just buying insurance. And let's imagine that, you know, I have insurance for my house, and something happened, and I'm just making a claim. So the insurance company just, you know, investigate the thing and eventually agree to pay your claim, and then is when the transfer is going to happen. So we will have the originator, that is the person that is actually insurance, and the originator PSP, that is us. We are just going to be moving the money. And there is a first step that is basically telling the PSP. The PSP is basically payment service provider. So it's basically telling the provider, please do a transfer to this person. Okay? So that is the first step. And what happens immediately after we get like a request from our customer? Well, the first thing that we check is obviously the balance. And the balance is one of those things that looks kind of very simple from the outside, and then when you are actually implementing the thing, it's not that trivial. Especially because there is especially in corporate banking, there is not only one type of balance, but multiple balances. Why? Because the settlement, the clearing of the money, the moment the actual cash is in the account, doesn't happen like instantaneously. So there is a gap that can just range from a few seconds to a few days, where the money is on flight, just moving from one account to another. And it's not settled in the destination yet, but it should not be available in the origin either. So during this moment, that part of your money is blocked. So we have what we call the real balance, that is the real money that you have in your account, and then we have something that we call the available balance, that is the real money minus the money that is on flight. And then we have even a third kind of balance that is, okay, the available balance plus the money that you are just going to receive, because receiving money, again, is not happening in real time. So there is a moment in time that you are just the target or the beneficiary of some money, but it's not still in your account. So there's multiple different balances. We usually handle the available balance more than any other, but we have to keep track of all of them. So again, we basically check, you have a claim for 200 euros, your available balance is 1,000 euros, so okay, let's go ahead. Next step is something we call the sanction list. And this is a big fucking mess, to be honest. Like, every single public institution, like governments, every government in the planet, they publish periodically sanction list for different people. Terrorists, crime, all kind of countries, like, we have seen like very clearly the sanctions from the European Union to Russia after the Ukraine war. So that is something that happens all across the world, and it comes in all kind of formats, all kind of periodicities. It's very difficult to actually keep track of all of these sanction lists. But the fact is that if I know that the people that is receiving the money, the beneficiary, is in one of these sanction lists, I'm actually forced by law to block the payment, not reject the payment, but block the payment and investigate what is happening. So it's not that I can say like, I don't want to make your transfer. It's that I have taken notice that you want to do this transfer. There is something fishy with this transfer, so I'm just going to block the money, and then I have to investigate what is happening. This, by the way, are real data just taken yesterday from the sanction list of the Bulgarian State Agency for National Security. So this is people that if I actually get a transfer for, I'm just forced by law to stop the payment and investigate again. So that is one thing. Then we have another thing that is called PEPs, politically exposed people, and this is not criminals. These are not criminals. These are people that just have any kind of public charge, and they can be just political in the European Union, local administration, they can be just people in the army, all kind of different roles. Sometimes it's even the famous people, like football players. They are usually in this kind of PEP list. And again, a lot of different formats. Basically, every single country on the planet publish their own list on their own formats. And again, if I find that someone is sending money to Izaskun Bilbao Bandarica or Adam Bielan, I'm just required by law to actually block the payment and investigate why. The reason in this case is not crime, is because you could actually trying to bribe public represent, or just trying to corrupt them, or you could actually be trying to do something fishy with a government. So again, that's another step that we have to do before even we start the transfer. All this happens it should happen like in a few seconds at the very beginning of the process. So we have done that, and then what happened next? What happened next is that we have to actually send something to the beneficiary's PSP. Remember, like we are the originator PSP, the originator bank. The people that is receiving the money, they have their own bank. That is the beneficiary's PSP. How do we actually communicate with them? Well, there is this standard, ISO 20022. Traditionally, all these exchange between PSPs was a fucking mess again. All kind of custom different file formats that were never standardized. Starting in 2007, the ISO committee introduced this standard, and it has been proven very successful in its adoption globally. Particularly because it just can do everything. There is a lot of different definitions and schemas for everything, like not only payment initiation, but direct debit, card transaction, Forex, ATMs, fraud reporting. Like there are so many things and so many schemas, XML schemas that you can use to communicate in a standard way. And again, it's basically used by all countries that are just doing modern initiatives in the payments space. So yeah, we have that standard, and now is when the bank transfer starts. And this is it. Like, you know, it takes like a few steps to move money. I will try to be not very boring with this, but it actually takes to understand the process to know what you have to wait 72 hours to get your money. That is something that happens very often in the weekends for a simple transaction. Again, we have the first step, originator PSP. We ask the originator PSP to move 200 euros. The originator PSP have to actually send something that is called like SCT-INST transaction. That is basically an instant credit transfer. That is the meaning for the SCT, Sepa credit transfer. We have to send like a transaction from our PSP, ourselves, to something called the CSM. That actually means clearing and settlement mechanism. That is what has been traditionally called a clearinghouse, and it's a mechanism to move money efficiently between two parties. Imagine this is one bank, this is Santander. I don't know a name of a Bulgarian bank. It could be one that is Borica or something like that. Is there one bank like that? Yeah, that's the thing. So that could be in the other side. The CSM is actually netting the operations between the two. So if I'm moving just 2,000 operations from this side for a value of 1 million, and then another 2,000 operations from that side for 500,000, the CSM will actually net both things and just move here 500,000. So you don't have to move the money every single time there is a transfer. So it's just a mechanism to make the thing efficient. But it's a completely independent system. Remember, this is a cluster of services. This is another cluster of services. This is another cluster of services. Their own, you know, processes, machines, everything, software, everything is independent. So we move the transaction from the originator PSP to the CSM, and then in turn, the CSM relay the transaction to the beneficiary PSP, and the PSP have to say, okay, I have to do the same process that the originator has made before reaching this step. So I have to check the sanction list, I have to check the PEP list, I have to ensure that the money can be actually be deposited in this account because it's not closed or under investigation. It has to do all those things and then reply with an OK or a KO to the CSM and say, okay, we accept the money, or we don't accept the money. Then, if that happens, the CSM has to say, okay, acknowledge, like, you know, we are okay that you are just going to be setting the money in the account. Then, at that moment, the funds are just made available to the beneficiary if the transaction is going to be settled. So all this process, and then eventually the CSM relayed the result to the originator PSP to say, okay, the money is going to be settled in the destination account. So, I know. Okay, so that is what it takes to make like a simple transfer. When you just move 10 euros from an account to another account in another bank, this is happening in the background. So which constraints are actually played to this? So first, there is a 10 seconds execution limit end to end. So from the moment, if we just go back, from the moment the XML is timestamp here in the step 2 to the moment that we get to step 6, maximum only 10 seconds can happen. I know that just coming from web development, that looks like an eternity. Like, it's 10 seconds, there's plenty of time. But again, you have to remember that, all these are just independent systems. We are just not processing la request in 10 seconds ourselves. We're just doing a small part of the flow and trying to make it as fast as possible, moving to the next step. These guys have to do very much the same steps again. These guys have to do the same steps again. So actually it's very easy just to get close to 10 seconds. For most of the transactions, like I would say 95%, usually gets under 4 or 5 seconds. But it really depends on the destination. Like again, there are just super big banks like Santander, and then there are just super tiny banks like, a small local farmers bank in South France, like, and they probably have like 3,000 customers. And the infrastructure, as you can imagine, is completely different. And the ability to respond to these kind of flows in these constraints are just totally different. Again, another constraint, 100,000 euros max per transfer. That is something that has been raised from 25,000 in the beginning in 2017. So it's going to be increasingly higher, but that is the current limit. And 24/7 during the whole year. And you will say, well, again, for the people just working on the web, that is the normal. That is the standard. For the banks, it's not. They have never worked like this. This is completely new for them. They are used to work in batches. They are used to stop the machines on the weekends. They are used to just transfer files by FTP. That is still today in 2024 the usual thing between banks. So kind of a hard constraint for them just to get to internet standards for their operation. So all this stuff that I have mentioned is just one scheme, just one. That is the Sepa credit transfer instantaneous. So that is just one scheme. And eventually, most PSPs have to support many other schemes. So the same thing that we have just talked can happen in batches, not instantaneously, so there is no limit on the time windows. There is another very interesting one that is called request to pay. I'm just pretty sure that every single person in this room has a debit card on their pocket. If you think about it, debit cards are just a simple proxy to the money that is in your account. There is no real reason for debit cards to exist, because contrary to what a credit card is basically a credit line. So basically money that the bank is giving you in advance for you to spend. A debit card is just using your own money. So it is literally a proxy. The European Union is about to introduce something called request to pay that will actually allow me to ask another person can you please send me 25 euros? That could happen in a peer-to-peer environment, or it could happen in a retail store, or it could happen anywhere. So the reasons to actually have a debit card after this becomes a standard is just close to zero. Because again, the debit card is just a proxy, and you don't need the proxy. And then verification of PG, another scheme that is going to be introduced next year. Because all this kind of movement from batches to instant, there is increased opportunities for fraud and for criminals to trick you and trick you just to send the money to the wrong person. So the European Union, again, sorry, the European Union, again, is going to introduce another thing that basically let you say to the other bank, please let me know if the beneficiary of this account is this person. And that is target to actually prevent fraud and crime in an automatic way. So, yeah, that is basically what is happening like in the European Union today when it comes to bank transfer. So, not simple, kind of complex, again, heavily regulated. We can do things technically that we can't officially. And that happens all the time. We just find that we could potentially do something, and then the regulation says like, no, you can't. So it's a very interesting niche if you like it. And we have just learned some things. But to explain them, I need to actually introduce the company a bit. We started in 2019 as a salary advance company. I don't know if you have heard the term salary advance before, but it's basically this idea of protecting workers, but instead of just leaving them to get payday loans or micro loans with high interest, using the money that they have accrued in their own companies as a source of income. So if you have been working for 15 days and you just get like a 2,000 euros at the end of the month, 15 days mean like half of the month, so you are entitled to 1,000 euros. And we basically created a system that we provided to the companies where they could actually give apps to their workers that will allow them to basically say 24/7, I need 100 euros because my washing machine broke, and I need those euros now to repair the washing machine. So we started doing that. We have like again, like a Rails API from the very beginning, a few native apps, and then a lot of custom integrations with the payroll systems. Those were like a nightmare. If you think that the Android market is fragmented, it's because you don't know the payroll system software market. It is incredibly fragmented. There's no standards, and for us, it was important just to be able to feedback the information of the advances to the company. So that was kind of hard. We wanted SMAC at the very beginning of 2020 because of the COVID, but then after that we saw like a substantial growth. We were just working with big companies like hospitality networks with big hotels, food mega groups like Unilever, these kind of companies, and we were seeing like good growth, but at some point we, after just spending 2 years, we realized that we were just going into a road that was not making us becoming like a product company. Because of this, all this effort that we have to put in the integrations with the different companies, every single customer just take forever just to onboard. Like onboarding Unilever could take from 3 months to 6 months from the moment we sign the contract to the moment they just go online. And that was like a big problem because again, we have to do like a lot of custom integration, and it was difficult to make it scalable. So at that point, we just thought like, you know, maybe we are just doing all the heavy lifting that we have mentioned before about just making transfers. Maybe we are just applying the thing in the wrong problem. We're just solving this thing of salary advances, trying to provide liquidity to workers, and that is only one small application of what we can do with this technology. So we moved to becoming a payment providers in the second quarter of 2022 with a focus on the European Union and what is called account-to-account payments, especially instant and real-time. We are still today like a small company. We are only 7 developers, but at this point we're just moving like hundreds of thousands of transactions per month and a few dozens million euros per month. So kind of okay for a startup that is starting. And then we are just hopefully getting like a proper PSP license this summer after 3 years of work. So that is us. And then what happened in this kind of context? Well, the first thing is that from the very beginning, we were just very aware that this kind of environment was going to require us to have like a lot of business logic, and business logic that is not only just modeled by ourselves, but in a very special and interesting way that is modeled by regulation. So we don't choose to make the things in a certain way. We don't always have the freedom just to make it in a certain way. So that was kind of a very important requirement. All of these constraints are tweakable, like different companies require different constraints, and we have to take into account if the company is an insurance company or is a crypto exchange. They have different risks, so we have to tweak the business logic in different ways in a very easy and simple way. And we found that, you know, that Rails is mostly agnostic when it comes to business logic. It implements the MVC pattern, but other than that, you know, you are on your own. And at that point, we are just a diverse group. There's many people just coming from Node and Go and many other technologies in the team. And they just brought with them different ideas that we have seen in clean architecture, for example, like service objects and use cases. We were aware too of things like interactors and in Hanami operations in Trailblazer. But again, none of these strategies was, you know, their way, the Rails way. It was not in the doctrine. So at the same time, in 2019, Shopify started publishing like a series of posts about just making what they call like a modular monolith. And what is a modular monolith? Well, first is basically splitting the business logic in different parts. And you can just call the parts component, packages, domains, whatever. They have many different names, and it depends on how Taliban you feel. You will just say, no, it is domains, or no, it is components, but it's basically the same stuff. Then you introduce clear boundaries. So you say, like, you know, this is the component, this is their business logic, this is the role, and this is another component with another role, and these are just separated. But in order to be functional, they have to communicate between them. So you just build simple interfaces. So one component can interact with another in a very specific way. And that forces you to actually realize, oh, so this component depends on these two others, and therefore changes on this one can affect to these other two. That is something that in Rails, it could actually just go unnoticed sometimes, because, you know, there's just by default no real boundaries between all the models, all the controllers. You can introduce modules, but many people don't do it. So it kind of forces you to do that by default. So it made a lot of sense for us, and we saw the first application very easily when we pivoted from Salary Advance to be a payment service provider, because until that moment, we have modeled Salary Advance in a way that the component never touches the money. So basically, the Salary Advance domain was asking the banking domain to do the movement without actually touching the money. So the moment we stopped just providing the service of Salary Advance, the banking domain remained untouched. There was literally zero changes, zero downtime, zero upgrades, zero migration, because the domains and the responsibilities were very clearly separated. So what is the difference then between a modular monolith and what has been so in fashion for the last 10 years of microservices? Well, the most obvious thing is that there is basically in-process communication. There is no HTTP connections or interchange or communication. And that is something that it begs to remind very often this table. Like, you know, HTTP has a lot of, you know, overhead, a lot of complexity, and if you're just simply defining the boundaries between your business logic, very often you don't need like completely separate services. You just need clear boundaries. There is no need for actually just making a TCP round trip between data centers or something like that. So we wanted modularity, but without the logistical complexity of deploying, like, Kubernetes and all this stuff that is so fashionable these days. So that was our main approach. Just, okay, we're just going to build like a modular monolith, and we were happy with that. And as the tales say, they live happily ever after. But no, like we have to introduce constantly reminders and practices in the team to make them aware, or to make ourselves aware that we were dealing with money. And one of the most common practices was to actually look to everything like defensive programming or offensive programming. What that means is that I have tried to pick the most simple examples. For example, when you're just receiving the response of a PSP, even if we have documented like 3 only possible cases, we will never implement the thing or the management like this. Like expecting that the other party is going to behave exactly as is documented. We never do that. Why? Because first, the documentation of most APIs is obsolete most of the time. People don't take the care or the time to actually keep them updated. Sometimes people don't do due diligence when they do breaking changes, and that happens all the times. And in our case, approaching the problem like this could actually mean that we just don't do something that is important when there is a deviation from the norm. So this is a simplification, but we will always have something like this. Like if something unexpected happens, stop. Don't do anything. Don't move the money, don't accept the money, don't do anything. Just raise an alert, let some human manage the thing, learn from the change, and then implement another case, a new case that is protecting from this corner case. So we always have this kind of paranoid feeling about what we are doing in the code. And it's kind of very ingrained in the team to the point that they feel kind of paranoid all the time because they don't want to mess up. But it's very useful because that means that when we are just confronted with unreliable partners, unreliable providers, we are usually doing the right thing. That is detecting the case, raising the hand and saying like, okay, someone has to actually check this. Learn from the problem for the next time and keep improving. So that is one thing. Another very common problem in when you are just moving money that is critical idempotency. It is a good practice in general. Like if you need to do something that is a transformative action, you better not do it twice in general. But if you're just moving money, you don't want to do it in any case. So this is a very common scenario. A customer sends a payment request. We just relay the request to the beneficiary PSP. Something happens, because always something happens. There's always something that happens for some reason. Then our customer retries the payment. It probably thinks like, their customer probably say like, the money is still not here, so I will just try again. And then they just send the money again, and eventually both payments got confirmed, and then you have paid twice. And that is not like a technical problem, it's a people's problem, but it happens all the time, and we have to make all the possible thing to prevent it. So basically, we introduce a very common practice that is just unique IDs that only are processed once in a given time. Like for example, in 72 hours, this ID is going to be only processed one time. So if the customer just send it twice, the second time it will just get the same response that it got like the first time. So preventing the duplication. We audit everything, like every single thing that happens on the system is just audited all the time. Like when we get a response via webhook, we audit the thing. When we just process the change on the state of a payment, we audit the thing. We just keep record of everything. We are just mandated by law to do it. There is no way that we can actually prevent this thing. This is not for the sake of it, but it's because we are just required to do it. Like a regulatory institution could actually ask me in 2 years, what happened with this specific payment, and I have to be able to say what happened exactly, to the point that we even audit ourselves. Like, there is no direct access to the console in our case. It is audited too. So you have to log in into the console, and every change that you do in the console will actually be audited to reflect that you are just making the changes for some specific region. Another few things that we discovered there where we were just very happy to be using Ruby for. A retry system, like I say, like most of the transfer happened without any problem, but if you just move like a lot of transfer for a day, even a 2% rate or 3% rate is a lot of transfers. So we have been just creating DSLs to basically collect the type of policies that we want to do in certain scenarios. This is a real one. This is the complete code. There is no simplification here. Sepa, this kind of bank transfer, has a series of errors that are just called AB. Those are basically timeouts. Timeout of the originator PSP, the beneficiary's PSP, the CSM, etc. So we basically have a very simple way to say, like, if this happened, we want to do this thing for this loan with this kind of approach, if we want like some kind of exponential fallback or whatever. And this is something that is useful not only for us, it's useful for the people that works with us in compliance, or the people that has to, have a clear understanding of what we are doing when it comes to retries, and it helps us to keep the business logic on focus without having to actually mess with the details. Another example of DSLs, again, I think Ruby ability to create DSLs remain unmatched in most other languages. This is an example for what we call transaction monitoring system. This is actually a step that happens for every single payment. I didn't include it in the first section of the talk because I thought it was enough. But on top of everything that we mentioned before, we do these too. So every single time we're just doing a payment transfer, we are checking and answering questions like, is the amount way lower or way higher than usual? Why are you sending 100 euros to this IBAN for the 7th time in the last 72 hours? Why is the company receiving this money and sending it to this counterparty this often? We have to make all those questions. And if we don't have like a clear answer, we block and we investigate. We are just mandated by law to do that. So again, very useful to be able just to create these DSLs with helpers and the abilities of Ruby and Rails. And another example of what these kind of thoughts bring us to do is the documentation. We are just an API first product. It actually becomes the product for the people that is integrating us. Like what they actually see is our documentation. They don't see our internal implementation. For them, the documentation itself is the product. So we just take great care of creating the best possible documentation. We have implemented testing procedures even for the documentation. So we just create like a we create like some pipelines that are automatically in the integration system. They just run the test, so we can boot up an instance of our monolith, take the documentation, make the request to the monolith, to the instance, as they say in the documentation, and actually check if the response from the real software matches the documentation. So we can actually be 100% sure that whatever we put in the documentation is actually factually accurate, and it gives us the opportunity to implement even dynamic portions of the documentation. We can actually interpolate like real values from the source code. So yeah, I'm just going to finish very fast. Sorry, these are just very common mantras in the development. But imagine that you just go to your local branch and you ask them like, how do you conduct business? And they say like, well, as a bank, we move fast and break things. That is exactly not the mindset that you want for a bank. That is exactly the opposite that you want for a bank. So instead of that, we just have like a few different principles. You can just read them in our blog. But I will just end up with one special principle that's very important for us. It comes from a sentence from the Cold War: trust but verify. I think in Russian it's something like doveraj but proveraj, something like that. I think in Bulgarian probably is kind of close to that. And it means that we do expansive testing, we just review ourselves through PR reviews, we have success monitoring, automatic and manual checks. Like, we trust our team to do the best work possible, but even then, we double check, triple check, verify. Always be verifying, because the risk of not doing it is too high. So that's everything. I know that has been like a dense talk. Thank you very much, everyone, for staying with me.